Hello, and welcome to this installment of our Industry Leader Conversation Series. I'm Brian Dobson, Head of SPAC and Disruptive Technology Equity Research at Chardan Capital Markets. Today, I'm joined by Luvleen Sidhu, the CEO and founder of BMTX. Prior to founding the company, Luvleen held a variety of senior executive roles at BankMobile and BooZ & Company. We're also joined by Bob Ramsey, Chief Financial Officer of BMTX. We have a buy rating on shares of BMTX, and our reports are available upon request. Luvleen, thank you for joining us today.
Thanks, Brian. Happy to be here.
And we're very happy to have both of you. So I'd like to start with a big picture question to articulate management's vision for the company and view of the sector in which it operates. So let's take it up to 30,000 feet. What megatrends do you believe are driving the sector, and how do they shape your outlook for the next 2 years? And further, how does your company prosper in that environment?
Sure, I'll be happy to take that first. So there's many exciting macro trends that we are seeing that I think are very pertinent to our business and help fuel growth opportunities for our business. So for example, one trend that we've seen in 2021, it's really become a buzzword everywhere, is this idea of embedded finance and banking as a service. We've been doing banking as a service for years now when we actually signed a contract with T-Mobile and launched the first really banking as a service large enterprise program in the country with T-Mobile Money. And what we're seeing is this trend and this understanding that this is becoming more mainstream. When we were doing it back in the day and we launched in 2019 and obviously signed the contract before that, we had to sort of educate, brands on why this is beneficial, versus now brands are really coming to financial services BaaS providers like ourselves and saying, how can you help us? And so this trend of moving away from branch-based acquisition, which was all about convenience of proximity, to a new type of redefining of convenience to the customer, which is, hey, we already interact with XYZ brands on a daily basis. Can we get our financial services from there if it makes sense? And so we're helping to drive that. We're one of the first movers in that. And I think we've only just scratched the surface in terms of this new trend of banking as a service. Number two, I'd say that in 2021, it's been a huge year of crypto. The reality is that 1 in 5 Americans today owns Bitcoin. And so I think that there's no sort of ignoring this trend that, we're very focused in the US, and that's why I say Americans, but it's definitely a global phenomenon. But, Americans want to be able to have crypto as part of their overall financial planning. And so we're going to see more and more fintech companies incorporating the ability to be able to participate in some capacity within the ecosystem of crypto. And that includes us as well, which we've talked about over the next 12 or so months. We will be incorporating that into our digital banking platform as well. A third trend that we're seeing is this idea of sort of unbundling back to rebundling. And so when fintech was really taking off, you would see the SoFis of the world, for example, were really good at student loans, right? Or you look at Robinhood, and they were really good at investing, right? And now what you're seeing is this realization that the CACs are too high and the customer lifetime value is too low. And so what we're really seeing is this, that's from the business model standpoint, the business standpoint, but also from a customer standpoint where it's like, hey, why do I have such a fragmented experience? Can't I just have the convenience of my holistic financial life within one umbrella? And I don't care where I get that from. You could white label it, doesn't matter. I just want to have that value within one single umbrella. And so you've seen, the announcement yesterday of SoFi getting their charter, but they've really extended beyond, a student loan to depository relationships to banking as a service. You've seen Robinhood try to do the same. You're seeing others try to just extend the share of wallet. And we're no different. And we're leveraging that trend as well, where we started with deposit gathering, but really building out that ecosystem of banking, lending, advice, investing, insurance, crypto, so that we have one holistic umbrella to be able to serve our clients. And I'd have one more trend, because we'll touch upon it later, and we're very much a part of this trend, is the trend of fintechs acquiring bank charters. I think that there's been this realization, when I've talked about the unit economics before, which is high CACs, low CLV, and really just struggling, how do we create a profitable model? And there are different avenues to achieve that, but one of the most obvious ones is to really vertically integrate and combine the best of fintech with the best of a charter. And so, I mentioned SoFi already getting the approval yesterday. Lending Club in the last few months, last year, got approval as well. Varo, through more of a de novo process, got approval. Square got the ILC charter. So you're beginning to see this, and obviously, that we also announced a merger with First Sound Bank. And so we believe in this macro trend that's taking place of vertically integrating the charter with the technology, and we're doing the same.
That's wonderful. I think it really encapsulates the long-term goals of the company and what's going on in the sector. But I guess what's next in the very near term? Can you talk about some of the hurdles that you might have to overcome, particularly in the next, call it 6 to 12 months, and how you plan to tackle those?
I think that, Brian, for us, our number one priority is to become a fintech bank, right? And as you've seen from Lending Club and SoFi, that this is a process, right? A process of working with the regulators, putting forth your business plan, and making sure that we go through the regular cadence that it takes to get the regulatory approval to become a bank. Fortunately, we're in a position where we were a bank for almost 7 years prior to becoming an independently traded fintech in 2021 on the New York Stock Exchange. And so we have confidence in our ability to be able to execute a banking business model. And so, but that doesn't deviate from one of the main priorities of this year, is that we want to work full force in working collaboratively with the regulators to get that regulatory approval and execute on our transaction. So that's number one sort of priority for this year. We're also very focused on our student business, which I think we're very well respected for in the marketplace, which is we've created such a unique customer acquisition strategy, which if you ask about later, I'm happy to talk through how that works. But, for us, it is about having the best student account out there so that we're acquiring new students, adding so much value to them and retaining them for life. And so this year is also about upgrading and enhancing that product that we have in the student market, modernizing that product to our most modern digital banking platform that we've built. And so we're investing a lot in making sure that the product is ripe for the sort of acquisition and retention that we want to deliver in the student market.
Excellent.
Yep. Yeah, third, and our banking as a service always remains a high priority for us. We've talked about sort of one significant partner a year or every 12 to 18 months. We're very picky and choosy about the banking as a service clients that we work with, but we have such a strong API built digital banking platform for us to be able to plug in with the right partners that we believe will have scale, have a good business model, have a good acquisition strategy. And so our priority, again, is also to continue to diversify beyond T-Mobile and our banking as a service strategy. And lastly, as we become a bank, it's really about deploying this low-cost deposit that we're able to acquire. We're so good at acquiring low-cost deposits, but being able to deploy those in high-yielding assets and really developing a robust, compliant asset generation strategy, both through, we're open to organic and inorganic means to do that. And so as a whole, these 3-4 things are really priorities for us in the coming year.
Excellent. Thank you for that. Thank you for that deep color. I guess let's delve into your business verticals, university and banking as a service. Your university business is very impressive, as you represent over 1/3 of college and university students. So for the benefit of investors that are new to the story, Would you give us a brief overview of the unit and your plans for its evolution over the next 2 years?
Yeah, I'm really proud of our student business. And as I said, I think that we're recognized for what we've created there, which is it all comes down to solving pain points for our customers. And so it really starts at the top of the funnel with our universities and colleges that we serve. The reason that we're able to even serve the university students is because we are serving the colleges and universities with something that they need help with. And what they need help with is disbursement of financial aid refunds. It's the amount left over once financial aid is applied to tuition. And we are helping to disperse $11 to $12 billion a year for our colleges and universities. And to do this in a compliant manner, in a very customer service oriented way, and a very student centric way. And in return, what we've opened up is that out of the 745 plus colleges and universities that we have relationships with, 1 in every 3 college bound students goes to one of those schools. And we get to ask those students, how would you like to receive this money? ACH an existing bank account, or to open up a very compelling BankMobile checking account, which, as I said before, we're enhancing, we're upgrading, we're innovating on to constantly make better and better for our students. And so our priority in the student business over the next year, I had already mentioned, which is how do we continue to have strong growth in new acquisition of students, but also to have growth on the retention side. And so what we're really doing is the first step is modernizing the product itself, making sure it's the best in class customer experience from an app and mobile banking, a digital experience. And what we've built on the banking as a service side is our most modern digital banking platform. And we are converting that over to our student platform to enhance the experience and help with acquisition and retention. We're also looking at, once a student graduates or once they become non-enrolled, to be able to service them with more products than we do today. So whether that's starting with the checking account, adding on the savings account, which we do beautifully today, but what more can we do? And we've talked about the robustness of the digital banking platform that we're building out and that we want to be able to service to these customers. And lastly, let's just take a step back, and it's the top of the funnel. How do you continue to really provide value to the colleges and universities that we serve, right? The reason we get access, as I said before, is because we're helping colleges and universities. So that has to remain at the center of what we do. And so we've introduced new services to be able to offer our colleges and universities in addition to refund disbursements, which we do today. And that includes ID solutions. So being able to couple up the debit card that we offer with an ID solution on campus, which we're doing through partnership with TouchNet, or to be able to help our schools better make payments through a vendor pay relationship and product that we have now offered them to the market. So those are really the prongs of which we think about student business growth.
That's an excellent encapsulation. I guess as a follow-up, as you add new colleges to your system, what type of leverage are you able to generate on the fixed costs of the business? We assume the flow through is significant on incremental colleges and universities. Is that true?
Bob, do you want to maybe take this one?
Yeah, I'd be happy to take that. So yeah, you're exactly right. The marginal cost with every new college or university is de minimis, right? We've already built all the infrastructure. We don't need to hire additional people to handle 1 or 2 new schools, et cetera. So it really is basically all leverage. The incremental cost of adding a new school is all variable and is not significant. So
great.
So for example, if we added 12, 15 schools last year, we didn't add any more people to be able to implement those schools and put them into, yep.
Excellent. So, I guess just to kind of close out this topic, there's been a lot of conversation on the Hill about student loan forgiveness as of late. How could that impact your business? And do you think that forgiveness ultimately leads to higher tuitions, perhaps more lending activity, perhaps more university business for you?
Yeah, so for us to have student loan forgiveness, firstly, does not impact the flow that we are in today. And so for us, as we said before, we're in the business of once a student has been granted a loan, we help the school disperse back to the student what is owed to the student after that a loan is applied to tuition. So as you can see, we're sort of out of the flow of actually providing the student loan or contingent on generating revenue from the interest and the payment of that loan. And so that's number one, right? So we aren't affected by that directly. Secondly, there's even a chance that as students know that there's been so much grace in sort of payments that the actual volume of student loans and the desire to sort of apply for more loans may increase. And so that would just drive even more business for us. And in terms of schools actually increasing tuition, we haven't seen that trend yet. I think there's a lot of pressure right now in the educational system, especially we saw with COVID where students weren't even on campus and having to pay the same tuition. And, just the idea of where's education going with these, digital platforms that are available, et cetera, that this ability to really hike up tuition, we're not seeing it. There's actually a lot of pressure on colleges and universities. So overall, I think with all these different moving parts, at this point in time, we are not at risk in terms of influence or impact on our business in a negative way.
Excellent. So let's shift over to banking as a service, which I believe is a very exciting aspect of your business and holds the potential for explosive growth in our view. However, it's difficult to sign deals similar in magnitude to the marquee agreement that you have with T-Mobile. I guess, what opportunities for growth do you see within your current agreement with T-Mobile Money? And has the Sprint deal opened you up to a new customer base to market within that agreement?
Yeah, so that had a couple of components to it. So let me take the fact that banking as a service, as I said before, I am also very bullish on it. I think that the trend and the understanding of banking as a service and the ability for non-banks to really leverage this in ways that help them grow their own businesses is finally becoming to the forefront. And so the opportunities for players like us have just increased. Then you talked about how these take time. And they take time also depending on how picky you are. A lot of opportunities actually come to us. But for us, we are really looking at this time for scale, meaningful, significant opportunities to participate in. And we're able to be picky and choosy just because of where we sit and what we've demonstrated already with a large brand, our capability. And so those deals do take longer. And that's why we sort of say 12 to 18 months to really be able to see the fruition of a new partner to come on the platform. In terms of new opportunities, the pipeline is strong as well. We're seeing interest across various different industries and verticals that see value in embedding financial services within their ecosystem. We've seen live examples of T-Mobile and us, as we said, and I will acknowledge your question and answer it directly as it relates to T-Mobile and our relationship and the growth opportunities. But we've also seen the announcement of Walgreens getting into this, so pharmacies showing interest in this, where we've also seen Credit Karma, so a fintech credit-focused opportunity. And we continue to see opportunities within the grocers, large box retailers, airlines. And so I think that there's a lot of untapped potential here and our pipeline remains strong. In terms of T-Mobile, the opportunity to grow that relationship continues to exist in a very healthy way. And so when we think about the T-Mobile relationship, it's number one about just having a very strong primary banking relationship and making sure that the product continues to innovate and stand apart on its own. And so we have a very robust product roadmap with T-Mobile into 2022 that continues to enhance an already very strong value proposition account that we have out there. And so that's very exciting for us. A second pillar of the T-Mobile program is how do we engage in more and more channels? And so we've really launched this in a digital capacity. And we continue to enhance and invest in the marketing around digital acquisition within T-Mobile owned assets and outside of T-Mobile assets to really acquire new customers. But there's also untapped channels within T-Mobile that are still opportunities for us, whether that's acquisition through call center, whether that's acquisition through the 5,000 plus retail branches that they have, et cetera. And so that remains an untapped opportunity for us as well. And lastly, the third pillar of the program is how do we create synergies with the broader core, right? How can the T-Mobile Money product and the ecosystem that we're building in this financial services hub really add value to the broader T-Mobile ecosystem? And so we have ideas there that I can't speak to, as T-Mobile is a public company, but exciting opportunities to continue to enhance the T-Mobile ecosystem in a way that benefits the larger organization.
Wonderful. And I suppose as you're looking out over the next year or two, where do you see the most opportunity for that business in terms of growth?
Yeah, I mean, as I said before, I think that there's three things that we're looking at, and we're looking at how do we enhance the product and make it not just primary worthy because we're already there, but really to have the bells and whistles, as people say, that really makes this an attractive account. And our robust product roadmap for 2022 really exemplifies that. And I can't go into detail of what that looks like. But we're working on executing that, and we have some exciting rollouts planned for this year. And we really hope that we're broadening the ecosystem also with products, whether that's our own product or that's T-Mobile working with other financial services providers within the T-Mobile Money ecosystem to add breadth to it, and really products that help the overall wireless, ecosystem, device financing, et cetera, that's just so natural to a wireless ecosystem. And so, yeah, I think the opportunity from a product expansion standpoint, from more channels, where I said that we're really digital today, but expanding into care, expanding into the retail channels, are untapped opportunities for us as well. And so, already with a sizable, we don't talk about T-Mobile as a separate vertical. We talk about it under the new business umbrella because, as I said before, they're a public company and we're not going to publicly disclose information that impacts them. But if you look at our new business vertical, which is primarily, T-Mobile, you see it's a very healthy portfolio. We see it's $1 billion plus in deposits. You see that 17% of that portfolio is active transactors. These are customers that are direct depositing. They're doing 5 or more transactions a month, and they're spending $17,000 or more annually. Those are really robust, engaged customers. And that is the cohort that we continue to grow and invest in. And it's really impressive what's already been built.
And we've still penetrated less than 1% of their base. So there's a lot of room for continued growth.
Yeah, it's certainly a very compelling aspect of your business. So let's spend a little time talking about the what we think is a very exciting merger that you have with First Sound Bank, which provides you with a bank charter. That's a very important and exciting next step for your business. So perhaps you could elaborate on what opportunities this merger unlocks for you, and importantly, how is the transaction with First Sound different from other fintech bank mergers?
So, as I said in my earlier remarks, that this trend towards vertically integrating the fintech aspect with the bank charter is becoming more and more popular because it's very clear that to create a sustainable, profitable business model into the future, that this is a very attractive way to do so. And so in terms of what it unlocks the potential to create more stability around our current economics, and also an expansion opportunity of those economics as well, because now you have both sides of the balance sheet. You have the deposits as well as high yielding assets to deploy those deposits. And so number one, it's that. Number two is it really puts us in a more competitive position as a banking as a service provider. So today, being a banking as a service technology provider, we are reliant on a partner bank to be able to execute on a banking as a service deal. And so when you have 3 people involved in orchestrating a banking as a service deal, the client like a T-Mobile plus a partner bank plus us as the technology provider, you have less seamless of experience, more parties involved in approvals and execution, and more parties involved in the same economics. And so it really enhances our existing banking as a service vertical as well. There's also a very unique opportunity to be able to cross-sell new products and new services that you have access to as a bank. And lastly, you've seen these sort of models, whether it's MetaBank, WebBank, Sutton Bank, et cetera, where as a bank, you are in a unique position to be able to have access to that charter, access to that BIN sponsorship. And so from that place, you have more revenue opportunities than what exists as a technology company that are really just untapped opportunities for us.
Excellent. And do you think that the interest income that comes from that transaction, eventually from the deposits associated with that transaction, do you think that may lead to lower earnings volatility in the future over the longer term?
Bob, do you want to take that one?
Yeah, sure. I'll take that. So I think the real benefit, I know Luvleen said this, is that the transition will help us, provide sort of more security or stability around the earnings. We're not going to have to worry about, hey, what does the fluctuation in interest rates mean for what we can earn in a deposit servicing fee, or what is the competitive market like now? Instead, we are going to take control of our destiny by generating net interest income off of those deposits by deploying them into loans. Now, of course, there's still a little bit of interest rate risk there, but we believe that the net interest margin that we will earn, if you look at the banking industry, is 3% plus, maybe 3 to 4%. Given that we will have a healthy component of consumer lending in there, which is consistent with our depositor base, we believe we could be towards the higher end of that range over time once we've sort of matured and built out the portfolio. And so we see the opportunity to expand the earnings potential off the deposits from what we're able to get today.
Excellent. Well, Luvleen, Bob, thank you for your insights. I believe that this has been time very well spent, and perhaps I'll wait a moment for questions to filter in from our audience. I have a few that have already arrived, and if it's all right with you, perhaps we could touch upon a little bit of Q&A.
Sure.
Great.
So our first question pertains to your customer acquisition costs. They are very low in comparison with your traditional bank and fintech peers. Can you describe why you excel at this and how you expect that to continue over the next few years?
Sure, I'm happy to take that. And then Bob, if you want to add anything. Our customer acquisition cost, or our CAC, is definitely a competitive advantage. And it's a competitive advantage when you look at both traditional banks and, of course, neobanks. And we talked to investors today that also, you get excited about the neobanks and really everything behind it. But the reality is that they spend so much money to acquire a customer, and then the CLV is really hard to make it high enough to really make up for that cost of acquisition. Versus we've created a model where our CAC is less than $10. And how are we able to accomplish that? Well, if you look in our student business, I've already explained it, which is we're always in the business of solving pain points. We were able to solve a pain point within a market, which is universities and colleges that were looking for this to be solved. And we created a niche, and we created expertise, and we created a foothold in an industry that's also, slow moving, you could say. And so an opportunity for someone else to sort of take this market is difficult. Plus, we have 99% plus retention. So it's not that we're just keeping captive an unsatisfied, university pool. They are so satisfied with what we're providing them. So when you combine that, we've created a strong foothold based on good service and good product and good business. And so in essence, by actually solving a pain point for the colleges and universities, they in return pay us annual subscription fees. And so in reality, we subsidize any cost involved with a sales team that helps support more college university growth, for example. And so our cost of acquisition really becomes negligible. And that's what we've been able to create in the student market. And our banking as a service vertical, it's really about, as I talked about, we're picky and choosy about who we work with because we want to work with companies that have entrenched customer bases, that have scale today, that have engagement with those customers today. And so that is what we're betting on. That is what we're leveraging. And in return, we're trying to give them the best financial services products to be able to service customers that they already engage with daily. And so that again minimizes the customer acquisition cost of an open market approach of trying to just blindly go and find customers for your product.
Yeah, I think it's the real benefit of our banking as a service business is that we are leveraging a partner's existing customer base. And it's always easier to make that cross sell than it is to sell a complete stranger. And as Luvleen said, the student business is even better because we're being paid to reach these students that are at a natural decision point where they have money that's coming to them. They're choosing how to have it dispersed. They may be in a new geography. I mean, it's really the opportune time to try and reach a new banking customer.
Excellent. So our next question has come in and it's related to your strategic merger bank. Can you just few products that you may be offering after obtaining that charter? And how do you feel about the transition from fee income to interest income?
So I don't know if it was just on my side, but I lost you, Brian, for a second. If you could just repeat the question, that would be helpful.
Sure thing. No, I was worried that we'd get through this with no technical difficulties, so I'm glad that happened. This question is about your merger with First Sound Bank. And the question is, can you describe some of the new products that you're offering? And also, how do you feel about the transition from fee income to interest income?
Yeah, I'll take it first and then Bob, you can add. So I don't want to describe this as a transition from fee income to interest income. It is a combination of both. We have strong fee income today, and we will have strong fee income as a fintech bank. Fee income today comes through our interchange revenue. It comes through our account fees, which isn't bad for students. Account fees includes, wire fees, card replacement fees, etc. It comes through university fees. And so we will continue to have strong fee income. And even as banking as a service providers, as the technology provider, there is, you could call it software as a service fees coming in. So there's a lot of fee income as a percentage of overall revenue in our model. The interest income, is a strong component as well. And we really view this as a strengthening of that component because today we are reliant on our bank partners and what do they dictate for, really paying us what we should be earning on our deposits. And so that volatility or that uncertainty or that lack of autonomy goes away with us having the ability to be able to deploy those low-cost deposits on our own. I don't know, Bob, if you want to add anything or...
No, I'd agree with all that. I mean, our revenues are really the same with the substitution of net interest income for the servicing fee, which really is the same concept of how do you monetize the deposits. It's only that as net interest income and as a balance sheet lender, we have more control over how we generate that income. And we expect it to be wider over time than it has been historically.
Great, thank you. And for those of you listening, please email any questions you have directly to me, and I can relay them to the team. So our final question, if no others come in, relates to statements you've made about your market cap, wanting to create a company that's in excess of $500 million in market cap. We certainly have a positive view on the share price. How do you envision this unfolding?
Yeah, no, I've definitely said that from day one because I have high conviction in that. And we have a pathway. So it's not just a conviction that's not backed by a pathway. I mean, even if you look today, we are one of the few neobanking fintechs, banking as a service providers that are profitable. And so, if you look at any multiple of how you want to value this company, from a multiple of revenue, a multiple of EBITDA, a multiple of net income of what we have today and where we're going, we're undervalued today, and we only have a roadmap of enhancing our economics through the various verticals that we're playing, whether that's growing student, whether that's growing banking as a service, whether that's growing our asset generation strategy, and something that we haven't talked about yet, but a niche sort of direct to consumer strategy. And there's so many things that we're working on and growing, and we've just shown revenue growth, we've shown EBITDA growth, we've shown net income growth, and we've shown account growth. And so, we're undervalued today, and in any multiple of the future, we can definitely hit that 500 million to $1 billion, in my perspective.
Agreed.
Excellent. Well, thank you both so much for your time. Thank you for joining Chardan and providing us with your insights for both the company and the sector. And we look forward to continued conversations in the future.
Great. Thank you so much,
Brian.
Brian. Thank you.
Thank you.
Appreciate it.